Right now, while you're watching this video, a force that most Bitcoin investors have never even thought to study is quietly doing more damage to the Bitcoin price than any hack, any government ban, or any whale sell-off ever could. And the deeply unsettling part is that this force doesn't live inside the crypto market. It lives inside the global monetary system itself, operating through channels that the overwhelming majority of retail Bitcoin holders have never once looked at. What I'm going to show you in this video is the hidden mechanism that connects the world's oldest financial power structure to the price of the world's newest monetary asset. And once you see it, you will never look at a Bitcoin price chart the same way again. Stay with me all the way to the 14-minute mark, because what I reveal there is the part that the mainstream financial media is almost completely ignoring right now. And before we go any further, this is not financial advice. I'm not your financial advisor. Nothing in this video should be taken as a recommendation to buy or sell any asset. This is macroeconomic analysis and education. Always do your own research and speak to a qualified professional before making any investment decisions. With that said, let's get into the part that actually matters. The crypto market has developed a deeply ingrained habit that is quietly costing investors enormous amounts of money. And that habit is the reflexive search for a crypto-specific explanation every single time the Bitcoin price drops. Something dramatic must have happened inside the crypto ecosystem, the thinking goes. An exchange must have been hacked, or a major fund must be liquidating, or a government somewhere just announced something terrifying, or a whale, that mysterious, omnipotent figure of crypto mythology, decided to dump millions of dollars worth of Bitcoin at the worst possible moment for everyone else holding the asset. And occasionally, those things are genuinely relevant. There are moments in Bitcoin's history where a specific crypto-native event was the primary driver of a significant price move. The collapse of FTX in November 2022 being perhaps the most obvious recent example, where the failure of a major centralized exchange triggered cascading liquidations and a confidence crisis that sent Bitcoin from around $21,000 to below $16,000 within weeks. But here is the critical insight that most Bitcoin investors are still missing in 2026. Those moments are becoming less common, not more common, as the Bitcoin market matures and deepens. Because what has changed over the past 3 years is not just the price of Bitcoin or the size of its market cap. What has changed is the fundamental character of who owns Bitcoin and how they make decisions about buying, selling, and managing their exposure. As of mid-2026, Bitcoin is held by a genuinely diverse mix of institutional investors, including hedge funds, asset managers, sovereign wealth funds, corporate treasuries, and pension funds that have accessed the asset through the spot ETF vehicles that launched in the United States in January 2024 and subsequently in other major markets around the world. These institutions do not make buy and sell decisions based on crypto Twitter sentiment or the latest on-chain metric. They make decisions based on portfolio risk management frameworks that incorporate macroeconomic conditions, interest rate environments, liquidity conditions, currency dynamics, and cross-asset correlations, the same frameworks they use to manage their positions in equities, bonds, commodities, and every other major asset class. And that shift in the ownership base of Bitcoin means that the forces moving the price of Bitcoin are increasingly the same forces that move every other globally traded risk asset. Which brings us to the force that almost no one in the crypto conversation is discussing with the seriousness it deserves. Now here's the part that most people in this space are completely missing. The real driver of this correction isn't in any crypto data feed. It's in the global monetary system itself, and it has been building for months. To understand what is actually happening to Bitcoin right now, you need to understand something about the US dollar that goes far beyond the surface level narrative you typically hear in crypto circles. In crypto communities, the dollar is usually discussed as the thing Bitcoin is trying to replace. The inflationary fiat currency, the tool of central bank manipulation, the symbol of monetary debasement. And while there is legitimate intellectual substance behind that framing, it completely misses the more immediate and operationally important role that the dollar plays in global financial markets right now, today, in a world where Bitcoin is still in the process of establishing itself as a global reserve asset. The US dollar is the world's reserve currency, and that status creates a set of dynamics that affect every single investable asset on Earth, including Bitcoin, whether Bitcoin advocates like it or not. Approximately 80% of global trade is invoiced and settled in US dollars. Commodities from crude oil to gold to agricultural products are priced in dollars on global exchanges. Somewhere between $12 and $13 trillion of debt held by borrowers outside the United States is denominated in US dollars, meaning that the cost of servicing that debt fluctuates directly with the value of the dollar. Central banks around the world hold roughly 60% of their foreign currency reserves in dollar-denominated assets. The interbank lending system, trade finance, and international capital flows all run on dollar liquidity. And what this means in practical terms is that the strength or weakness of the US dollar functions like the tide in the global ocean of capital. When the dollar strengthens significantly, it creates an enormous gravitational pull that draws capital from around the world toward dollar-denominated assets, toward US treasuries, toward money market funds, toward short-term dollar instruments that are suddenly offering real, attractive, risk-adjusted yields. And as capital flows toward those safe, yield-bearing dollar assets, it flows away from riskier alternatives, from emerging market equities, from commodities, from speculative technology names, and yes, from Bitcoin. Think about what that means from the perspective of a foreign institutional investor sitting in London, Tokyo, Singapore, or Sao Paulo. If the dollar is rising, your local currency is weakening against it. Every dollar's worth of Bitcoin you hold is becoming more expensive to maintain in local currency terms. Meanwhile, U.S. Treasury bills are offering yields that were essentially unimaginable for most of the past decade, and they carry virtually zero credit risk. In that environment, the rational institutional calculation increasingly favors rotating toward safety and yield over maintaining speculative risk positions. Morning, afternoon, or night, where you are right now? Drop it in the comments. I'm genuinely curious what part of the world is watching this unfold in real time. That gravitational pull of the dollar is what Wall Street macro traders refer to when they talk about risk-off conditions, and those conditions are precisely what Bitcoin is navigating right now. Here is where the conversation gets genuinely uncomfortable for some people who have been in the Bitcoin community for a long time, so I want to address it directly rather than dancing around it. Bitcoin was designed to be independent of the global dollar system. The fixed supply, the decentralized network, the proof-of-work mechanism, the removal of trusted intermediaries, all of it was architecturally constructed to create a monetary asset that could exist outside the control of any central authority, including the Federal Reserve and the U.S. Treasury. That design is real. The properties are real. And the long-term thesis that Bitcoin represents a credible alternative store of value in a world of expanding sovereign debt and monetary debasement, that thesis is intellectually serious and remains intact today. But here is the reality of the market we are actually operating in right now. Bitcoin does not yet trade as a fully independent, uncorrelated monetary asset. It trades as a high beta risk asset inside a global financial system that is still entirely dominated by the US dollar, and its price is therefore significantly influenced by the same liquidity and dollar dynamics that affect every other risk asset in that system. The evidence for this is not subtle. During the extraordinary liquidity expansion of 2020 through early 2022, when the Federal Reserve expanded its balance sheet by nearly $5 trillion and drove real interest rates deep into negative territory, Bitcoin's price rose from approximately $7,000 to nearly $69,000, a roughly tenfold increase during a period of maximum dollar weakness and maximum global liquidity. During the subsequent tightening cycle, when the Fed raised rates at the fastest pace in 4 decades and the dollar strengthened dramatically, Bitcoin fell from those highs to below $16,000, a decline of over 75% that tracked with extraordinary precision, alongside the deterioration in global liquidity conditions. This is not coincidence. This is the Bitcoin liquidity relationship operating in real time, and ignoring it in favor of purely crypto-native explanations is one of the most expensive mistakes a Bitcoin investor can make. What's also critical to understand is the mechanism through which dollar strength creates direct demand headwinds for Bitcoin specifically. The vast majority of Bitcoin buyers globally, whether retail investors in emerging markets, institutional funds in Europe, or individual savers in Asia, are purchasing Bitcoin with currencies that are priced relative to the US dollar. When the dollar strengthens, every one of those buyers faces a higher effective price in their local currency, even if the Bitcoin price in dollar terms hasn't moved at all. That is a real reduction in purchasing power, and it creates real downward demand pressure that shows up in the price. Comment below if you're starting to see why the macro picture is more important than most crypto channels are letting on. There is another dimension to dollar strength that almost no one in the crypto conversation acknowledges, and it matters enormously for understanding the current environment. Across the emerging market world, in countries from Turkey to Argentina to Indonesia to South Africa, governments, corporations, and financial institutions took on massive amounts of dollar-denominated debt during the decade of near-zero interest rates that followed the 2008 financial crisis. When the dollar was weak and borrowing costs were negligible, this debt was entirely manageable. But when the dollar strengthens meaningfully, the burden of servicing that debt increases in direct proportion, because borrowers must spend more of their local currency to purchase the dollars needed to make interest and principal payments. This dynamic creates cascading financial stress across entire emerging market economies, which forces institutional investors and sovereign wealth managers to pull capital back toward dollar assets for safety, which in turn tightens global liquidity further, which creates additional headwinds for every risk asset globally, including Bitcoin. It is a self-reinforcing feedback loop that can sustain dollar strength and risk-off conditions for much longer than most investors expect. And understanding it explains why Bitcoin corrections during dollar strengthening cycles tend to be deeper and more persistent than corrections driven purely by crypto-native events. While retail Bitcoin investors are analyzing candlestick patterns and monitoring the latest ETF flow data, the institutional investors, who now represent an increasingly significant portion of Bitcoin's ownership base, are looking at a completely different set of indicators. And understanding what those indicators are is one of the most valuable things you can take away from this video. The first thing serious macro investors watch is the US dollar index, commonly known as the DXY, which measures the dollar's value against a basket of 6 major global currencies: the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. The DXY is perhaps the single most important indicator of global financial conditions for risk assets, because it captures the direction and magnitude of the gravitational pull that dollar strength is exerting on global capital flows. When the DXY is rising toward or above key technical and psychological levels, risk assets face meaningful headwinds. When it reverses and begins trending lower, risk assets, including Bitcoin, tend to breathe more easily. The second critical indicator is the direction of Federal Reserve policy, and perhaps more importantly, the market's expectations about where policy is heading. The Federal Reserve has maintained an elevated interest rate environment through much of 2024 and 2025 as it worked to bring inflation back toward its 2% target. And even as some rate adjustments have occurred, the overall stance has remained materially tighter than the extraordinary accommodation of the 2020 to 2022 period. It is not just the actual rate level that matters. It is the forward guidance and the market's interpretation of that guidance, because asset prices move on expectations, not on realized events. The third indicator that sophisticated institutional investors watch is global M2 money supply, which is the broadest measure of money available in the financial system across the world's major economies. Research conducted by leading macro analysts has demonstrated a historically strong correlation between the growth rate of global M2 money supply and the price trajectory of Bitcoin, with Bitcoin prices tending to lead global liquidity changes by somewhere between 3 and 6 months on average. When global M2 is expanding, there's more money available to flow into risk assets, and Bitcoin, as one of the most liquid and globally accessible risk assets, tends to be a primary beneficiary. When global M2 growth slows or contracts, that tailwind disappears. Hit like if this is connecting dots that you've been trying to connect for a while, this is exactly the kind of framework that changes how you navigate these markets. The fourth indicator is the behavior of credit markets, specifically credit spreads, which measure the premium that lower quality borrowers must pay above Treasury yields to access capital. When credit spreads widen, it signals that financial conditions are tightening and risk appetite is contracting. When they compress, it signals the opposite. Bitcoin has historically been highly sensitive to credit spread movements because they reflect the overall appetite for risk in the global financial system. Understanding these 4 indicators, DXY, Fed policy expectations, global M2, and credit spreads, gives you a framework for contextualizing Bitcoin's price movements that goes far beyond anything available in purely crypto-native analysis. Let me give you the longer historical perspective that is absolutely essential for understanding the current moment without either panicking or being naively complacent. Global financial liquidity, the total availability of money and credit in the financial system across all major economies, does not move in a straight line. It moves in cycles, driven by the policy decisions of major central banks, the dynamics of global credit expansion and contraction, and the shifting risk appetite of institutional investors around the world. And throughout Bitcoin's 15-year history, its price has moved in remarkable alignment with those liquidity cycles. Not perfectly, not with mechanical precision, but with enough consistency that ignoring the relationship has been a reliably expensive mistake. The cycle that drove Bitcoin's most spectacular bull run, from roughly $7,000 in early 2020 to nearly $69,000 in November 2021, was fueled by the most extraordinary expansion of global monetary liquidity in modern financial history. The Federal Reserve, the European Central Bank, the Bank of Japan, and central banks around the world simultaneously deployed unprecedented stimulus in response to the COVID-19 pandemic, expanding their collective balance sheets by tens of trillions of dollars, driving interest rates to near zero or negative levels, and flooding the global financial system with cheap capital that needed somewhere to go. In that environment, maximum liquidity, near zero yield on safe assets, deeply negative real interest rates, speculative assets like Bitcoin became extraordinarily attractive, and they performed accordingly. The subsequent tightening cycle, which began in earnest in early 2022 as the Fed began its most aggressive rate hiking campaign in 4 decades, produced the opposite result with equal clarity. Bitcoin fell from its highs by more than 75%, as the liquidity environment that had sustained its rally was systematically dismantled by rising rates, dollar strength, and contracting global M2. Now, in mid-2026, we are navigating a transition period whose ultimate direction is genuinely uncertain and fiercely debated among serious macroeconomic analysts. Some indicators suggest that the tightening cycle has run its course and that the next directional shift in global liquidity is toward expansion. Central banks in several major economies have already begun easing, and the pressure on the Federal Reserve to follow is building. Other indicators suggest that structural factors, including persistent fiscal deficits, elevated sovereign debt levels, and the residual inflationary dynamics embedded in the global economy, could keep dollar yields elevated and financial conditions tighter for longer than the consensus currently expects. What happens next is the real story, and it's unfolding right now in real time. If you want to stay ahead of each major development as this transition plays out, subscribe to the Wealth Continuum, because we track this every single week with the same level of depth and rigor you're getting in this video. I want to be completely clear about something, because this video is about analysis and not about scaring you out of an asset that may still represent one of the most asymmetric investment opportunities of the current era. The structural bull case for Bitcoin in 2026 is not just intact in several important dimensions, it is stronger than it has ever been in the asset's history, and that needs to be part of this conversation. The launch of spot Bitcoin ETFs in the United States in January 2024 was not just a regulatory milestone. It was a fundamental structural transformation of Bitcoin's demand profile. For the first time in the asset's history, registered investment advisors managing trillions of dollars in client assets, pension funds operating under fiduciary mandates, and traditional wealth management platforms serving tens of millions of individual investors can now offer Bitcoin exposure through regulated, familiar, custodied investment vehicles that require no crypto wallet, no private key management, and no interaction with the complexities of the underlying blockchain. The cumulative demand from these vehicles has been substantial, and it represents a source of structural buying that did not exist in previous Bitcoin cycles. The April 2024 halving, which reduced the daily issuance of new Bitcoin from approximately 900 coins per day to approximately 450, introduced a supply shock that, in previous cycles, has preceded significant price appreciation over the subsequent 12 to 24 months. The relationship is not guaranteed to repeat with mechanical precision, but the mathematical reality of a fixed supply asset facing a 50% reduction in new supply entering the market is not something that can be dismissed as irrelevant. Long-term Bitcoin holders, defined as wallets that have held their coins for at least 1 year without moving them, continue to represent a substantial portion of the circulating supply, and their behavior through this correction has been one of continued accumulation rather than capitulation. This is the behavior of investors who have lived through multiple cycles, understand the volatility, and retain conviction in the long-term thesis. And then there is the fundamental property of Bitcoin that sits above all of these tactical considerations, and that no macroeconomic headwind can touch. There will only ever be 21 million Bitcoin in existence. No Federal Reserve meeting can change that number. No government can vote to increase it. No central bank can print more of it. In a world where sovereign debt levels across developed economies are at historic highs, where governments continue to spend dramatically beyond their means, and where the monetary debasement thesis for hard assets grows more compelling with each passing fiscal year, the fixed supply property of Bitcoin becomes more relevant, not less relevant, over time. What would you actually do if the bull thesis plays out fully over the next 2 years? Are you positioned to benefit from it, or are you currently sitting on the sidelines watching this unfold? Drop your honest answer in the comments. I read them far more carefully than you probably think. I want to say something directly that most financial channels won't say, because it's uncomfortable and it challenges the way most people think about risk. The biggest risk you face as a Bitcoin investor right now is not the risk of a price decline. Price declines are a predictable, recurring feature of Bitcoin's market cycle, and every serious long-term Bitcoin holder has already accepted that reality. The biggest risk is the risk of misidentifying the cause of a decline and making the wrong decision as a result. If you believe Bitcoin is falling because the technology is failing, or because institutional adoption is reversing, or because the fundamental thesis has broken down, and you sell on that belief, you will potentially sell at exactly the wrong moment, right when the macro conditions that have been creating headwinds are beginning to shift in the opposite direction. This mistake has been made by millions of investors in every single Bitcoin cycle. They sold in panic at prices that turned out to be extraordinary long-term entry points, not because they were wrong about Bitcoin's volatility, but because they were wrong about what was causing the volatility they were experiencing. Understanding that the current pressure on Bitcoin is primarily macro-driven, driven by dollar dynamics, liquidity conditions, and institutional risk management behavior rather than by any fundamental failure of the Bitcoin network, is not just intellectually satisfying. It is practically financially consequential. It is the difference between making a clear-eyed decision based on an accurate understanding of the situation and making an emotionally driven decision based on a misdiagnosis. Let me close with something concrete. Because frameworks without actionable indicators are just philosophy, and you deserve more than that. If you want to track the macro forces affecting Bitcoin in real time without drowning in noise, here are the 4 signals that actually matter most right now. Watch the DXY and specifically watch whether it continues holding above the 104 to 106 range or whether it begins breaking down through key support levels. Because a sustained DXY reversal has historically been one of the most reliable early signals of improving conditions for risk assets. Watch the Federal Reserve's language and the market's implied rate expectations, because shifts in Fed posture tend to precede shifts in dollar direction and liquidity conditions by weeks or months, giving attentive investors a meaningful lead time. Watch global M2 money supply on a monthly basis, because the research on the Bitcoin liquidity correlation is robust enough that sustained expansion in global M2 has historically provided approximately 3 to 6 months of advance notice of Bitcoin price strength. And watch long-term holder behavior through on-chain analytics platforms, because the accumulation patterns of experienced, conviction-driven Bitcoin holders have historically been among the most reliable indicators of where we are in the market cycle. None of these signals will give you a perfect roadmap. Nothing will. But together they give you a framework that the vast majority of retail Bitcoin investors are not using, and in markets, seeing more of the picture than the person on the other side of your trade is perhaps the most durable and repeatable edge that exists. So let's bring everything together, because you've earned a clear synthesis. Bitcoin is falling right now, and the forces creating that pressure are not primarily coming from inside the crypto market. They are coming from the global dollar system, from the gravitational pull of dollar strength on global capital flows, from the opportunity cost created by elevated yields on dollar-denominated safe assets, from the tightening of global liquidity conditions that reduces the financial environment's appetite for speculative risk, and from the institutional risk management behavior of the large, sophisticated investors who now collectively own a significant portion of the Bitcoin supply. None of these forces mean that Bitcoin is broken. None of them mean that the long-term thesis has changed. A falling Bitcoin price and a broken Bitcoin thesis are completely different things, and confusing them has been the most expensive mistake made by the most investors across every single Bitcoin market cycle that has ever occurred. Markets move in cycles. Liquidity moves in cycles. Fear moves in cycles. And throughout its entire history, Bitcoin has repeatedly and forcefully demonstrated that the investors who understand the macro environment in which it is operating, who can distinguish between a macro-driven correction and a fundamental breakdown, are the investors who are positioned to benefit most powerfully when the cycle turns. The next major Bitcoin move may not be decided inside the crypto market. It may be decided by the Federal Reserve. It may be decided by the direction of the US dollar. It may be decided by forces operating in corners of the global financial system that most Bitcoin investors have never once looked at. But now you're looking at them. And that changes everything. If you've been watching the wealth continuum for a while and this video finally made the complete macro picture click into place for you, drop the word clarity in the comments below. That single word tells me this macro Bitcoin framework is a topic this community wants to go deeper on, and I will build the next breakdown around exactly that. And I genuinely want to know, what do you want the next video to cover? We can go deeper into what a Federal Reserve pivot actually means for Bitcoin's price trajectory. We can break down the global M2 money supply cycle and where we are in it right now. We can analyze the full implications of the Bitcoin halving supply shock as it continues to work through the market. Leave your suggestion in the comments, and I will be reading every single one of them when I plan the next episode. Your input genuinely shapes what gets made on this channel. Share this video with someone in your life who is watching Bitcoin fall right now and trying to make sense of it. Because the clarity in this video could be the difference between a decision they regret and a decision they look back on as one of the best they ever made. Subscribe to the Wealth Continuum. Think differently. Stay early, build wealth.